Welcome to our Taking Stock video for the week ending the 24th of May, 2024. I'm Kien Trinh, Head of Research at Stock Doctor, and today I'm joined by our Senior Portfolio Manager, Matthew Swartz, to stream to your Think Share Market. Welcome, Matt. How are you today?
I'm going very well, thank you. And good to be joining you again.
I know, it just seems time flies, doesn't it, Matt? But before we get started, just a quick yet important reminder. The information we provide today is of a generic nature and therefore shouldn't be taken as personal advice. Remember, shares are volatile, so any past performance figures shouldn't be relied upon as a guide for future performance. Well, Matt, it's been quite a roller coaster week for the Australian market, and it was up early in the week, supported by those resource stocks, and that was due to higher metal prices from supply disruptions. And also there was a recent ban on Russian metals by UK and US exchanges. However, the rally did fizzle out by the end of the week, and that followed from minutes from the US Fed meeting, suggesting that it may take longer for inflation to move back to their target range.
Yeah, Ken, I am getting quite dizzy on the whipsawing expectations for central bank monetary policy at the moment. Nobody seems to be able to call inflation or interest rates with any real precision. So as JP Morgan's Jamie Dimon summed it up quite recently, literally anything can happen from here. And meanwhile, the artificial intelligence theme was boosted after the darling of the US chip makers, NVIDIA, posted an 18% quarter-on-quarter rise in revenue that did blow past its own expectations or guidance. And there was also some extra goodies in there for retail investors, with the company announcing a 10-for-1 stock split while also boosting their dividend payments. And Ken, US investors are a bit of an odd bunch at the best of times. Stock splits are effectively a zero-sum game, as you and I both know, but the perception of the share price being much lower oftentimes gets confused with the stock being cheaper, which creates some more buying demand. But broadly speaking, the first quarter US reporting season has come in better than expected, with about 78% of companies beating the market's expectations. But outside these blowout results from the mega cap tech stocks, expectations for earnings for the quarter were actually quite low. So effectively, companies are just beating Wall Street's low expectations. Moving forward, however, analysts are forecasting strong earnings growth, particularly in the second half of 2024. And we believe this optimism is too high in an environment where we are still in restrictive interest rates. But for now, market multiples are running ahead of themselves, driven predominantly by momentum and mega cap tech. You can see this on chart on screen, with which indicates the best performing factor in the US market for the calendar year to date has been momentum and market cap or size. The dynamic has played similarly across the Australian share market, with momentum factors also performing really well.
Yeah, Matt, the speculation seems quite rife there, but we remind the investors about the complacency, because momentum often drives share prices beyond fundamentals, and this will ultimately lead to share price reversals down the track, especially if earnings trajectories doesn't align with the share price. And with the confession season in full swing here in Australia, the trend in earnings remains quite weak, as highlighted by the chart on screen. You can see that the black line, that represents the earnings trend, which is down, while the blue line represents the All Ords index, which has been rising.
Yeah, it's an interesting dynamic that's playing out there, Keen, isn't it? And the weak corporate earnings landscape has mostly been driven by the consumer-driven sectors, such as staples and discretionary like retail, housing, construction, and telcos. For example, this week, retailer, the reject shop, building materials firm James Hardie, and pathology business Sonic Healthcare were sold down quite heavily after releasing earnings guidance, which was well below market expectations.
Yeah, quite a few major announcements. And along with those announcements, Matt, there were many more. So let's now turn our attention to a few stocks on our radar. Earlier this week, we had Telstra. They reaffirmed their financial year 24 earnings guidance. But some investors may be wondering why the share price has reacted so poorly. Now, there were a few factors at play here. The first I can see is that they also released earnings guidance for the following year in financial year 25, which was slightly below market expectations. Plus, they did remove inflation-linked annual price rises for their postpaid services. And many in the market thought that this implied that competition may be intensifying.
And in addition to that, Ken, the business plans to cut about 350 million costs through a strategic review, but this will mean it faces immediately a $250 million restructuring costs in the coming year. And with the rise in capital expenditures, such as acquiring additional band spectrum for high-speed 5G services and fibre routes, free cash flow is expected to fall below the dividend payments. But we do believe this is temporary, and the shortfall will be easily compensated by the healthy cash balance that they have of 1 billion. The stock is currently trading on a gross dividend yield of what we consider to be quite attractive, 7.5%.
Yes, the yield is certainly looking appealing there, Matt. But moving across to resources now, Karoon Gas, they are facing pressure from an activist consortium on the belief that management have pursued value-destructive M&A instead of focusing on better utilization and also earnings realization of their current assets. Only a year ago, Karoon did conduct a capital raise to acquire a 30% stake in the US Gulf of Mexico assets called Who Dat. What are your thoughts on this?
Well, apart from it being an interesting name, Who Dat, we do somewhat agree with the value destruction. I think if you sort of take the gauge of Karoon having two downgrades since this capital raise on those assets. But at the same time, we also think that it may be a little bit too early to tell if recent investments have underachieved, given that it's only really been a few months. So looking more practically at Karoon Gas, the pressure from a select few shareholders will encourage the board to probably pursue some capital management initiatives, such as a buyback or a dividend to appease these activists. But we think that it will support the share price in the short term, but long-term investors should obviously be focused on the production profile. And in the interim, the share price will be obviously highly correlated to the oil and gas prices.
Yeah, we'll definitely be monitoring this situation, Matt. But among the stocks we are also monitoring for potential inclusion in our Star Growth stock universe is corporate software business technology one. Now, the company did release a strong set of numbers with return on equity at 38% and profit margins fairly stable at around 23%. But the result that was really driven by the ongoing transition of customers from their legacy on-premise software to the cloud or SaaS products that appear to yield better margins. And the take-up of the additional in-house services, or what they call modules, from their existing clients, which appears to be the core driver of their earnings in the past 18 to 24 months.
And with the company bringing forward its annual recurring revenue target of 500 million to 2025, and also stating that they are incorporating artificial intelligence tools to improve its productivity, it wasn't much of a surprise to see investors and analysts react quite positively to the announcement. However, we are currently concerned about a few items, particularly the analyst. Ken, can you elaborate on those thoughts?
Yeah, it's just incredible how the word AI can spark frenzy among investors in the markets right now. But apart from that, so I guess some of the concerns we've had is the first one involves the emerging trends that we're seeing within the private and public and government sectors. And what they've been doing is deferring and cancelling technology and communication upgrades and services. This was evident with the recent update from Star Income stock Spark New Zealand. Secondly, we are concerned with the lack of growth of operating cash flow despite the business reporting strong earnings growth here. Technology businesses such as these, they can artificially inflate their profits by changing the way they capitalize R&D. And for more information on this, please refer to our strategic comment.
And looking at the week ahead, it's going to be a fairly quiet one for our Star stocks. However, we are looking forward to seeing the results from healthcare stock, which is on our watch list, Fisher & Paykel, and they have recently released an earnings upgrade in recent months.
So earlier on, Matt, you mentioned that retail appears to be under pressure. So for under the microscope this week, we take a look at Star Growth stock and Star Income stock within the retail space, Super Retail Group, which is known for its auto and outdoor brands, including Super Cheap Auto, Rebel, BCF, and also Macpac. The stock price has fallen from around $17 to now trade at $12. What has driven this negative price sentiment, Matt?
Yeah, it's much of the share price decline from our perspective is driven by this very weak consumer sentiment. The weight of high mortgage repayments and this period of sticky inflation is putting pressure on the consumer, who is actively pulling back on discretionary spending items. And this has become quite evident in the multitude of downgrades we've observed across the discretionary basket of the ASX. This is including Baby Bunting, Michael Hill Jewellers, Bapcor, The Reject Shop, and Tourism Holdings. They all released very weak trading updates.
Yeah, and that's what's led to those weak earnings trends we saw earlier on. But despite the challenging conditions, earnings forecasts for Super Retail Group, they appear quite resilient with revisions down only about 1% over the last 3 months. And looking at the earnings growth ahead, they are expected to decline by about 11%. That's not surprising. And that's due to higher cost growth as well, associated with wage rises. But during its trading update earlier this month, the business did allude to softer sales, especially across the BCF and Rebel brands. However, this was offset by strong sales in Super Cheap Auto and, of course, new store openings as well. So the diversity of its retail outlets has helped the business mitigate some of these challenging consumer conditions.
Yeah, I'd agree with that. They are quite a diversified retailer and a very strong one at that. But investors may be wondering, with free cash flow expected to decline over the coming year, whether the gross forecast dividend yield at 8% is achievable. And although dividends are forecasted to decline in the coming year, investors should be mindful that the business is highly cash generative and paid a special dividend last year, with its cash balance growing sharply from 192 million 6 months ago to 321 million today. There is ample room for dividend payments and further capital spending.
Yeah, it's so important to also look at that cash level as well, Matt. And the stock is currently trading at a large discount to fair value, but we believe the business is quite attractive at these levels. Charlie does think that the super retail will weather the current environment better than other retailers, and that's due to its older target demographic, which is less impacted by mortgage rates and tighter financial conditions. And along with the consumer sector theme under pressure, a question that is often asked among our members is, what is the best way to compare stocks within a sector on Stock Doctor?
And to compare stocks, the most obvious way is to refer to the peer comparison table in the 9 golden rule screen. For example, for Super Retail Group, the peer comparison table allows you to look at key golden rule metrics across various stocks within the retail sector. What stands out to me within this group is the earnings revisions, where there is a stark difference between the high quality retailers like Super Retail, JB Hi-Fi and Levis, for example, compared with the weaker ones such as Baby Bunting, Kathmandu and Michael Hill.
Yeah, good point there. For a broader and more dynamic range of metrics and sectors, such as forecast earnings and dividends, you can refer to the stock filter here. You can create your own filter, and let's call it consumer stocks, for example. Then select the GICS sectors related to consumer spending, such as consumer staples, discretionary communications, even construction materials here. Then select fields which are useful to you.
And in this case, we have included fields like forecast gross dividend yield, forecast earnings growth, earnings revisions, price to consensus target, 1-year return, and average daily trade. When selecting forecast fields, it's also important to screen for stocks with analyst coverage.
Yeah, otherwise there won't be anything there. And another thing you can do here is to screen for opportunities, Matt. For example, you may want to look for stocks with attractive dividend yields where earnings have been quite resilient. Then you can highlight those stocks that have a gross dividend yield of, say, above 7%, and then look for stocks with positive earnings revisions. A few ideas that come through this list include IVE Group, Autosports Group, Super Retail Telstra, and JB Hi-Fi here.
But also be careful here because sometimes there is a lag with earnings revisions data. So to double check on that, make sure you refer to any recent company announcements or trading updates. And meanwhile, Ingham's is also on this list, but there is heightened uncertainty with this stock given there have been some reported cases of bird flu.
Yeah, just make sure you are aware of the heightened risks among these businesses. But also another way you can also compare companies is under the watch list from your predefined portfolio or our star stocks. But as always, conduct your own due diligence and contact the analyst team if you are unsure. Well, that's all we have time for today. Thanks, Matt, for your contribution.
My pleasure, Ken. And if you do have any questions, please feel free to come along to our session of Lincoln Live on Monday morning.
And also a reminder that we did send out our expressions of interest for the Stock Doctor Platinum services. Now, this subscription provides you with exclusive access to our senior team, also premium events and portfolio analytics reports as well. So let us know if you're interested in that. For now, Take care and have a happy, healthy, and prosperous week ahead.